Welcome to Analytics Hub channel and welcome to this complete masterclass on navigating the financial markets. Today we are starting with the foundation, an introduction to the financial markets and trading. When most people hear about online trading, they think of scams, guessing games or holding an asset and praying it goes up in value over a period of time. We need to unlearn that right now. We are not investors looking to store assets, rather, we are traders looking to capitalize on price fluctuations. So, in this video, I'll be giving an overview of the financial markets and trading under these 8 topics. So, what are financial markets? Financial markets are platforms where financial instruments such as stocks, bonds, commodities, and currencies are traded. Instead of physical goods, participants of the market are trading digital representations of value. By currencies, I mean trading the value of one economy against another, e.g. swapping naira for US dollars. By commodities, it is trading raw materials that power the world. Examples are gold, crude oil, or even coffee. Then stocks means buying tiny fractions of ownership in major companies. This market connects buyers and sellers globally, ensuring efficient price discovery, that is, finding the true fair price of something at any given seconds, and also capital allocation. Capital allocation in the sense that the financial market is a system for moving money from where it is sitting idle to where it is needed most. So the question is, how did I participate in the financial markets? You do not need to fly to Wall Street to participate. Your smartphone or laptop and your connection to the internet is your direct portal to this global hub. Unlike in the 1990s, placing a trade was a highly physical and manual process. Before you could tap buy or sell on your smartphone, you need to physically pick up a landline telephone and call a stockbroker. You would tell them exactly what you wanted to buy and at what price. The broker would then write this order on a physical ticket, then call their representative on an exchange floor to execute the order. So thanks to technology advancement, trading the financial market is now quite easier. So in the financial world, the term platform is almost entirely digital. It is a massive decentralized network of computers, servers, and institutions connected across the globe. Decentralized in the sense that it is not controlled by a central body. Successfully navigating the financial markets means mastering a real digital skill and managing your risk. It is not a get rich quick scheme where you blindly hand your money over to an anonymous figures online. So take note of that. Basis of trading. What do we do in the financial market? What we do in the financial market is basically trading, right? Trading involves the buying and selling of financial assets such as currency, stocks, crypto to earn profit based on the price fluctuations of these assets. The fundamental principle that makes trading work is the connection between supply and demand, just the principle of demand and supply. When there are more buyers than sellers, demand increases, right? And so the prices. When sellers outnumber buyers, demand shrinks, causing prices to fall. This can happen for a variety of reasons, including economic indicators like inflation, GDP growth, and interest rates, as well as market sentiment and regulatory policies. Let me give an illustration. Imagine a local businessman in Nigeria who buys 500 bags of local rice in October. He assumes that because the land borders are closed and the festive period is approaching, the demand for rice will skyrocket and the price per bag will double by December. He is speculating on a future price increase. However, imagine if the government suddenly announces the reopening of all borders in November, flooding the market with cheaper imported rice. The price of rice crashes instead of rising against what he predicted. His speculation was wrong, and if he has to sell those 500 bags now, at the moment, he will lose a massive amount of money. But if his speculation was right, he will be in massive profit. So in the market, that's exactly what we do in the financial market. We look at the market structure and speculate on where the price is going next. But just like that businessman, we can be wrong. That is why we use risk management, so a wrong prediction doesn't wipe out our entire account. This is exactly why trading is not a guarantee and why we use stop losses. Whether it is a global pandemic, a border closure, or a CBN policy, we cannot predict the future with 100% certainty. We can only analyze the market structure, take a calculated risk, and protect our capital if the market decides to go the other way. Now, trading versus investing. Here is the biggest secret about the financial market. Most participants aren't actually looking to buy and store this asset in a vault somewhere. I mentioned that in the previous slide, right? So when you invest, you buy an asset hoping it goes up in value over the next 5 to 10 years. Just like people who bought Bitcoin when it was at a low price and now they are selling at an high price, they are investing. But only those who have a big bag to store, to buy a reasonable amount of Bitcoin will be making profit from it, right? So but as a trader, in trading, because we are only looking to profit from price fluctuations, we can make money in both directions. Whether Bitcoin is increasing from $20,000 to $30,000, or it is decreasing from $90,000 to $70,000, we can make money trading both directions. We can buy when the structure is pointing up, and we can sell when the structure is pointing down. We aren't selling the asset, we are just trading the movement, which means we don't need to own the asset in our wallet, but we can still capitalize on the price fluctuation with our minimum, with a capital as minimum as $10 or even $5 on some exchanges. Now, types of traders. The types of traders are simply categorized by how long they hold a trade to capture that movement. The scalper, these are the ones that uses the seconds to minutes time frame. The goal is just to grab tiny quick profits from very small price movements over and over again. This type of traders tends to like trade maybe 4 to 5 sectors in a day. The day trader, this one makes use of the hourly to minutes time frame for the analysis. That is on our trading view. So the goal is to capture the main price movement of the day. This type of traders tends to execute trade in about 1, 2, or 3 trades in a day, and within 24 hours the trade tends to hit TP or stop loss. TP as in take profits. Then the swing trader, these are the ones that make use of the day to week time frame for the analysis and for their execution. So the goal is just to catch a larger swing or a sustained trend in the market. Now, the position trader, these are the ones that are synonymous to investors. Their goal is to profit from massive long-term macroeconomic shifts. Moving on, what are traded in the market? So we have varieties of financial instruments that are available for trading. Some of them are stocks. Stocks are what? Shares of companies. We have bonds, governments, which are government and corporate debt. We have commodities like gold, oil, agricultural products like soybeans, wheat, and the likes. Currencies like the foreign exchange currency. We are trading the currency of Great Britain against the currency of Japan. We are trading the currency of United States dollar against the currency of Japan, or Europe against USD, like that. So derivatives, we have options, futures, swaps. Then exchange traded funds, ETFs. ETFs are just a bag of stocks. It's like instead of buying individual stocks, if you buy an ETFs or you own a fraction of an ETFs, it means you have access or you own a small fraction of collections of stocks. Major ETFs are S&P 500, US 30, Nasdaq 100. S&P 500 is just an index of the top 500 companies in United States. Now, we also have cryptocurrencies. We can also trade cryptocurrencies like Bitcoin, the common ones like Ethereum, SRP, Solana, and the likes. So what we just do is that we can access and trade these financial instruments through digital platform provided by brokers and exchanges. This is just a screenshot of what the financial instrument looks like on my trading view. So we have the section of stocks, we have the section for funds, futures, crypto, forex, and the likes. Moving on, mechanisms and strategy. Getting involved in trading as a complete beginner involves a series of steps. Here are 6 course mechanisms you can follow. Just like when you are venturing into a new industry or a new niche, you need to follow some guidelines, right? So number 1 is market dynamics. Know your terrain. Every market has its own personality. So as it is known that the financial market can be categorized into the big 3. So we have the crypto market, we have the forex market, and we have the stock market. So if you are trading in the current crypto market, you need to know how the crypto market operates. You need to know that the crypto market opens from Monday to Sunday, while the forex market, it opens from Monday to Friday, just the weekdays, like that. The language of trading, you must be familiar with the industry terminology like pips, lots, and leverage. Yeah, sure. You need to understand the basic terminologies in your industry so as for effective communication. Platform mastery. um Before you can place this trade, just like I mentioned that in the old days they use phone call through their stockbrokers to place trade. Nowadays we have some platforms like MT5, like exchanges like Binance, Bybit, and the likes, or to execute and place our trades. So we need our trading software is your primary tool. Then next is the technical edge chart reading. So basically we use 2 types of analysis in the market, which are technical analysis and fundamental analysis. By fundamental analysis looks at a company or country's economic, financial health, management, and industry position to determine its value, while technical analysis looks for patterns and trends in historical price, often using charts and indicators. Let me show you what technical analysis look like. So on my trading view, okay, so this is a currency pair, EUR/AUD. That is the currency of Europe against Australian dollar, right? So let's say I want to check the price action of gold. Gold is SAUUSD. This is currently the price action of gold, and for my chart I can tell that gold is currently at a price of 4,372.54 USD. This is the currency I'm using in my chart, and this is the current available price action of gold. So what we with our knowledge of technical analysis, we can look at the market structure of a price. We will look at where price is coming from, we look at where price is at, and from the information we get, we can use it to speculate on where price is likely to head to, and we'll capitalize on that. So moving on, we have the risk and money management, so which is the absolute rule of survival. For us, we need to know that risk management helps us protect our capital, because the goal is to make profit, but you can't make profit if you do not secure your capital, just like in any business ventures. So risk management tells you that okay, you have so amount in your portfolio, you can divide it into 10 or 20, so you have at least 10 to 15 or 20 chances of your prediction going right or wrong before you lose your portfolio totally. Money management is how you manage your positions, your active trade, or how you scale your money, how you grow your money, how you manage what you have in your portfolio, and the likes. So trading psychology, this is one of the biggest strategy that we need as a trader, because cultivating the emotional discipline required to execute your this involves cultivating the emotional discipline required to execute your strategy consistently. Two major problem traders battle with are what? Fear and greed. Because as a trader, when you fear to execute your edge, you might lose some profitable trades, and when you are greedy, you might tend to double down and risk your entire portfolio on a trade, which both of them are actually bad for you as a trader. Moving on, benefits and risks of trading. We have the pros and cons. There is no sugarcoating in this industry. So some of the benefits are Location independence. Yeah, just like we know that trading is a digital skill, just like digital skill are in the sense of remote jobs. You don't need to go to a classroom, or you don't need to have a go to a specific office before you can trade. Just with your access to smartphone and internet connection, you can analyze the chart and execute trades from anywhere in the world. The next one is scalability of income. Unlike a traditional salary that is fixed, your trading income scales with your capital and skill. That's true. Low barrier to entry. Okay, let me emphasize on that. Scalability of income. Yeah, we need to also know that we need to know the market cap of this financial market. So let me show you something. Yeah. So as of late March 2026, the crypto market cap is at estimate of $2.51 trillion. The stock market cap, or let's say the global stock market capitalization, is over $100 trillion based on recent structural trends, and the forex market is the largest with daily trading volume exceeding $7.5 trillion, which means in a day about $7.5 trillion is circulating the forex market. This is just to tell us to show us the big opportunities that are available in the financial market. There is no limit to how much you can make, and also you can lose all your portfolio. Moving on, low barrier to entry. You don't need millions of naira to start learning. You can begin practicing immediately for free on a demo account, and when you are ready, many brokers allow you to open a live account with relatively small amount of capital. After gaining the necessary skills in trading, you already know the niche, the sector you want to trade. If you want to trade the crypto market, the stock market, or the forex market, you have done your research, you have learnt your technical analysis, your fundamental analysis, and the likes. Now you can, as a beginner, you can practice with demo account. Demo account is where you paper trade. Like, they give you a test net, like you can sign up on a broker and they give you free $10,000, but that money is not real. It's just for you to practice, to practice your edge and develop a system for yourself. Then when you are confident, you can now move to a live account. It is when you trade on your live account you will now develop the emotions, you will now work on your emotions, your psychology as a trader, because that is where fear and greed lies. When great money is involved, there is emotional fluctuations also. Now the risk of trading are: number one, financial loss. If you trade without a stop loss or proper risk management, you can lose your entire investment capital very quickly. That's true. The psychological toll. Trading will test your emotional discipline more than almost any other profession, just like I mentioned. Then the steep learning curve. It takes months or even years of screen time, backtesting, and making mistakes to become consistently profitable. Just like I mentioned that when you are venturing into a new industry, you need to take your time in learning. Just like every digital skills, you do not expect to learn a new digital skill and in the next 2 months, 3 months you are already making money from it. No, you have to treat trading as a career, as a business. You have to give it some enough time, enough practice, and keep refining on your edge. So moving on, and finally we have trading as a business here. So this is just some set of advice that profitability begins with the moment you destroy the gambling mindset. Trading is not a hobby or a side hustle, it is a structured business. Navigating the market successfully demands massive devotion to continuous learning, unwavering patience and discipline, the emotional intelligence to embrace losses due to the volatility of the market, execution based solely on calculated risk. uh yeah, so I hope this overview gave you a solid foundation and cleared up exactly what the financial markets are all about. If this is a part you are considering taking seriously, share your thoughts in the comments, subscribe, engage, and stay tuned for the next videos in this series. And also in the description I will add a link to download this file. Take care. Bye.